Financial Modeling, Topic 14, Distributions, Distribution Fittings, and the Normal Curve, copyright Lou Gaddis. In this topic, we're going to select distributions other than the normal distributions, which we've been using for the entire course. We're then going to simulate portfolio returns and free cash flows using varying distributions, and we'll show you a different way of entering distributions within Excel. The overall process of doing a simulation, a Monte Carlo simulation, is you first create a model of a future outcome which has at least one stochastic variable. So for example, you may model the expected value of a stock, but you have to have at least one stochastic variable. A stochastic variable is one in which there's more than one outcome, and the distribution of the outcomes have a known distribution. You then specify the distribution of the stochastic variables. So say we're creating a portfolio or a model of my retirement portfolio at retirement, the value of the portfolio retirement. I'm going to specify the stochastic variable as the portfolio returns. And then I might choose the normal distribution for the stock returns. And then I'll set, say, correlations between the stocks and bonds. I'll then simulate many possible stock returns, which will then generate many possible portfolio values. And then what I'll do is I'll evaluate the distribution of the outcome. I'll look for things like the mean or percentiles. Now, so far in the course, we've limited ourselves to modeling asset returns using a normal distribution. That's right here. Now, we could have used some other distributions. For example, here's a student distribution, which is the normal with a little bit fatter tails. Or we could have taken a distribution that looks a little bit normal, but it might be skewed to the left or the right. For example, this extreme value. Or we could have done a log normal distribution, which is often done with asset prices. If I were to simulate coin tosses, I obviously couldn't use normal distribution. I'd have to use something like a Bernoulli distribution for heads and tails. And so there's many distributions. You know, this is one, kind of looks like a bell-shaped curve, but instead of having these types of slopes, it has these types of slopes. So again, these are all pictures of distributions in which you could use to model your random variables. Another would be a uniform distribution, one of the few distributions that's not peaked. A uniform distribution is one in which from the minimum value to the maximum value, they're just as likely, versus something like a triangular distribution in which you have a min and a max like uniform, but there is still a peak. You're going to get a lot more simulated values at the central area here than you are at the minimums and maximums. So the bottom line is when you select a variable in which you're going to consider a stochastic variable or one which has an uncertain outcome, you have a choice of distributions. Now, usually in finance, we do select normal. So, for a default assumption in financial markets, we usually assume that asset returns, percentage changes in asset prices, are normally distributed. And if you think about the distribution of a normal distribution, it is symmetric. It is unbounded, meaning that it's very unlikely to get, say, 3, 4, 5, 10, 30 standard deviation events, but they could still happen when generating those random values. And they're single peaked, or that there's a central tendency, symmetry, and unbounded. Now, often in financial markets, if we were to model prices, which we don't really do, we generally model returns and then use that to estimate prices. But if I were to, say, model prices, you'd use something like a log normal distribution, in which it's, say, bound at 0, you can't have negative prices, and skewed to positive values. So that would be another way of thinking about modeling prices versus returns. And it just so happens that if you assume asset returns are normally distributed, asset prices have this type of distribution called the log normal distribution. So I'm going to take this model, which we had worked on earlier. This is 80-some data of S&P returns, Treasury bill returns, and Treasury bond returns from 1928 to 2013. The mean is 11.5% for stocks, a standard deviation of 20, and I have a bill and bond mean of 3.5 and 5. and standard deviations of 3 and 8. What I'm going to do is I'm going to form a portfolio of 60% in stocks, 10% in bills, 30% in bonds. If I take my means times those weights, I get a portfolio mean. If I then create a correlation matrix based on this data, I get these correlations. So stocks, bonds, and bills are relatively uncorrelated, slightly negative, and bills and bonds are relatively highly correlated, 0.29. I then can use that to generate a covariance matrix, right? We can go from a correlation matrix to a vector of standard deviations, and we can create a covariance matrix. And then I calculate a portfolio standard deviation of bills, bonds, and stocks by using the M-mult transpose, or the M-mult of my covariance matrix and my weights. Remember, M-mult transpose WSW to the 1/2 power. So let's go ahead and grab this and put it in Excel. So I want to grab all the data. Even the data that's not shown. And where I got this data is from Damodaran, NYU professor who provides bills, bonds, and stock returns. I'm going to copy that. Close out, and I'll go to Excel. And I also have at-risk running. We're going to use that in a little bit. And I'll paste that into Excel. So here are my bill and bond returns with their mean and standard deviation. Here are my correlation matrix, covariance matrix, my portfolio returns, it's a sum product of the weights and the means, and my portfolio standard deviation, M-mult transpose WSW, where this S is my covariance matrix, this is my W. So there's my portfolio mean and standard deviation. Now, if you assume that this portfolio is normally distributed, perfectly normally distributed, with this mean and this standard deviation, we can make a lot of statements, because if you assume an asset is normally distributed, you can describe fully the distribution with those two statistics, mean and standard deviation. So what we're going to do is we're going to use this and calculate some statistics. Before I do that, let's actually just take a minute and think about whether, say, stock returns are normally distributed. And so I could do a data analysis histogram, and I could put in my stock returns, including the label. Click on label, and I could graph it, say somewhere out here, and maybe add a chart. So if I look at the last 80 so years of stock returns, what you see is there's quite a dispersion. Like the worst return was negative 40-some%. That would probably be 1929. And then some other bad returns. And it looks like it could maybe have a bell-shaped curve, but it looks like it's got a fat left tail. However, we're going to assume that a normal shaped curve fully describes this function, or this histogram. And I'm going to make a couple statements. And I'm going to use just, I'll call this normal distribution formulas to make some statements. So let me go ahead and put in my mean. I'll just have a link to this mean right here. And I want to make a couple statements. For example, what is the 5% lowest outcome if I assume lowest return, 5% lowest return, if I assume that this portfolio is normally distributed with the mean of 882 and 1211? Well, that would mean that the mean minus norm S inverse 95% times the vol. So the mean minus norm S inverse 0.95 times the vol gives me a value of minus 11%. So let's think about what that formula is doing. This is your VAR formula, except it doesn't use prices, it's in percentage terms. So what it's telling you is that the norm S inverse ran 0.95. That's telling me that the normally, if I assume a normal distribution, my z value, the number of standard deviations away from the mean that has a 5% likelihood of happening, one-tail test, is 1.65 standard deviations away from the mean. So the mean minus 1.65 standard deviations times the volatility is minus 11%. So if it's normally distributed with mean of 12 mean of 8, standard deviation of 12, I would expect that only 5% of the outcomes will be below 11%. So it looks like it's kind of violated here. So it looks like there's maybe a few more than 11%. And then I can also make statements that what is the probability of losing more than 30%? So I'll say that the returns are less than negative 30%. You know, what's the probability of a really bad move in the stock or in this portfolio? Well, I can use my norm dis function and figure out, well, for a 30% negative return with a mean of 38, that means it's actually 38% below its mean. Let me figure out how many standard deviations is 38% below its mean. So 38% over 12 is about 3 standard deviations. And let me figure out the probability of a 3 standard deviation event, one tail. So I'll do that with norm S dist. And I'll figure out how many standard deviations it is away from its mean. Minus 30%. Subtract the mean. That'll give me minus 38%. Divided by the standard deviation. So minus 38% is about 3 standard deviations away. That probability is about 0.07%. So again, norm S dist of the number of standard deviations away from the mean tells me that event should happen about 0.07%, which, looking at our data, we can see actually we've had looks like a couple days or a few years in the last 80 that are that bad. So it looks like that's understating the risk. Right, so far what we did is we taken our portfolio of stocks, bills, and bonds and modeled it using normal distributions and made some statements about the probability of losing 30% and the 5% lowest return. Now I'm going to use at-risk to calculate similar values. So what I'm going to do is I'm going to add 3 at-risk distributions for stocks, bills, and bonds using normal distributions. I'm then going to add the correlations among those. I'm going to simulate 10,000 possible portfolio returns. And then I'm going to look at the distribution. And I should get numbers real close to what I just did because I'm still going to use normal distribution. So I'm going to come over here and I'm going to add 3 distributions here. So again, this is I'll just copy these titles here. And let's call this at risk normal distributions. And how I'll do that is I'm going to go to at risk. I'm going to define distribution. I'm going to select normal. And then I'm going to put in, so right now it gives me some defaults, 0 and 10. I'm going to click here to assign Excel values. I'm going to put in the mean and standard deviation and hit OK. So what it did is it simply put a formula in there, risk normal, instead of 0, 1, risk normal 11, 19. Now, how we'd done this in the past is a little bit different, so I just wanted to show you the difference. In the past way we did random walk normal distributions is I would say that the mean plus risk normal 0, 1 was my random walk normal distribution, and again, times standard deviation. So mean return plus risk normal 0, 1 times standard deviation. This is another way of writing that. Now let me show you that. If I were to make both of these outputs, so I'm going to go to at risk, add output, at risk, add output, and I were to run distribution or 10,000 iterations on both of these, this is generating 10,000 equity returns using a normal distribution of a mean of 11 and a standard deviation 19. You can see the 5% worst case is negative 21%, which is, by the way, the same value. Well, no, we did that as a portfolio, so we can't talk about this. But this standard deviation, let's go back up, is the 5% worst is losing 21% in equities by themselves, not the portfolio, and 5% highest is 44%. Now, if I use this cell, browse those results, notice you get the same value. So there's two different ways of putting normal distributions in. I can either just take mean plus risk normal 0, 1 times standard deviation, or when I input the distribution, I could just make it risk normal mean standard deviation. I'm going to take the output out, and I'll delete this one. Now I'm just going to copy this formula over. All right, so now I'm going to assume that bills are distributed using historical mean and standard deviation, and bonds have a normal distribution with historical mean and standard deviation. Now I'm going to simulate a portfolio 60, 10, 30 using the at-risk values. So let's call this the at-risk normal distribution. And I'm just going to set a formula here to get the portfolio mean. 60% of the at-risk mean of equities plus 10% of the at-risk plus 30% of the at-risk bond returns. So there's my portfolio mean. Now, if I'm also going to make this an output. Now, when I run this distribution, what's going to happen? Well, I can't do it yet. I need to do one more thing. When I run it, it's going to generate 10,000 sets of 3 random variables for these 3 assets. But I want to make it sure that they're correlated using these correlations. So let me go to my model window, at-risk model window. Go to my inputs. I'm going to select my 3 inputs I want to correlate. Right-click, correlate, create new matrix. Make sure they're in the right order, S&P, bill, bond. Otherwise, I have to move them around. Right-click, copy from Excel. I'm going to copy this correlation matrix. OK. And then I need to output it somewhere. I'll just put it right here. And hit OK. And OK. And there's my correlation matrix that at-risk is going to use. Now, when I run my 10,000 iterations on this output, it's going to generate a random number for S&P returns. Then look at the correlation matrix. Using the correlation, then estimate a correlated random for T-bills. In other words, if this number happens to be high, it's going to be more likely to choose a high T-bill, and then do the same for T-bonds. So I'm going to run this simulation for 10,000. Okay, it's done. Now notice that the 5% lowest is losing 11%. That's the same thing as I did with that formula here. This 11 minus 11 is the same as this minus 11, the 5% worst case. And if I want the probability using at risk of losing 30%, I could just type in minus 0.3. And it's showing me about a 0.1%, it's just rounding a little bit, is the same. So this is another way of getting these statistics using at risk. Now I can get these out of the distribution by using risk percentile and risk target at risk functions. So if I say equals risk percentile, click on an at-risk output and put 0.05, it'll tell me the 5% lowest value. And there's my minus 11%. And if I say equals risk target, click on an output, comma, minus 0.3, it'll tell me that is a 0.08% chance of a 30% loss or more. Now you'll get slightly different numbers because you're going to have a slightly different group of random variables. So, and on the extreme variables like this one, it could be as different as say 0.05 to 0.09 or so. This one should be pretty close. So that's how to use at risk to simulate a portfolio of 3 normally distributed variables. Well, let's talk about what if we selected other distributions. Let's do something called distribution fitting. Let's let at risk look at our list of curves and try to fit all of these curves across our data and see which one fits the best. In other words, if the data fits the beta distribution more than the normal, let's use beta or another one. So let's try that. So what we're going to do is we're going to select each of our asset returns. So let's do S&P first. Grab our data. I'm going to go to at risk, distribution fitting, fit, fit. It's going to look at the data, plot a histogram, that's in blue, and then plot what they consider the best fit. And their best fit is a Weibull distribution, closely followed by normal. Now if I click on the normal, it'll plot both of them. So the blue line is actually the plot of how the normal fits, and looks like the Weibull in red is a little bit fatter on the left tail there and thinner on the right tail. So it appears that this Weibull is able to create a fatter left tail, thinner right tail. So it's going to predict more extreme events, but just a little bit more than normal distribution. And they have them ranked by some score, and you can read about that in the slide, talking about how they do that. But they score it, and it looks like the Weibull had the best fit. And you can actually look at the data here a little bit different, a little more. Now in the blue here where it says input, that's the actual histogram. So the 5% lowest of the actual data is losing 25%. If you use Weibull to model it and ask for the worst 5%, you get 23. If you ask a normal distribution, find an area under a curve of a normal curve with a fit over this data, it would be 21.49. And look, for the normal curve, it estimated your mean, 11.5, and it estimated your standard deviation of 20%. For Weibull, it also has estimated a mean and a standard deviation. So I'm going to click now on, I'm going to click off of normal, and I'm going to click right to cell, and it's going to put a formula inside a cell. I'll click next. Here's the formula it's going to add. And let me just put it up here. And I'll call these my best fit distributions. And the formula I put in there is risk, not risk normal, but risk Weibull. Some number, some number, some number, and a name. So let's actually click on that and click on define distribution. So the risk Weibull, the Weibull distribution, it looks like it's created a fat left tail distribution the parameters, again, for normal, it's just mean and standard deviation fully describe the function. It looks like to create this fat left tail, I need an alpha, a beta, and a shift variable. And I'm assuming those alpha and beta determine the peakedness, how dispersed the variables, the curve is, where it is on this line, whether it's farther left or right, and whether it's skewed to the left or right. And you can just go into the help and read more about these different distributions. But I'll just leave that. And then I'm going to put T-bills. Let's do the same thing for T-bills. So for T-bills, I'm going to do just distribution fitting, fit, Looks like if I look at the first few here, it looks like it wants the exponential, triangular, and inverse Gauss. Let's look at the top two. The exponential function, it's kind of a strange, looks like half a bell curve. It's in red here. So it's planted right here at 0. That actually the minimum right here is actually it's a little bit negative. I might want to adjust that. Well, no, I guess not. You can have negative returns on T-bills. So most of the data is right around 0, and every once in a while you get a higher return and a little bit of negative. Now it also fit a triangular distribution. If a triangular distribution comes straight up, has a minimum of about 0. Actually, we can look at it there. Has a minimum of about 0. And then it fits it along a straight line with a maximum of 14%. So it looks like the exponential function is unbounded, just like a normal curve to the positive. So all of these are bounded, the actual data, the exponential and the triangular are bounded on the left tail, and the exponential function is unbounded on the right tail, whereas triangular and the actual data is bound, obviously, this historical data. So I'm going to click off the triangular. We'll go keep the exponential, right to cell, and I'll put it in that next place. And then we'll do something different with the T-bond. We'll grab the data. At risk, distribution fitting, fit, and I'll look at the top two here. Notice normal distribution isn't even in the top 5 or 8 or 9, and it's down here below all these, including the Weibull. And what we see is Laplace is the top, log logistic. So Laplace is this really peaked, pointy distribution. The second one, the log logistic, kind of looks like a normal. And if I look at the statistics on those two, the actual mean of the data is 5.2, and log logistic gives me about a 5% mean. When it fits this curve, it then recalculates a mean based on, say, the skewed and the peakness. Again, and it shows parameters for these, whether the alpha, the beta, the shift, and the mean, the standard deviation. It picks values that best fit the data. However, when I do the Laplace, it looks like it changed my mean to 3.8. I want to go with the log logistic, even though it may fit this huge peak a little bit better. But just the idea that these distributions are a choice, and I'm just going to pick it because I don't want to change the mean of my distribution that drastically. So I'm going to write that to a cell using the log logistic. Remember, I unclicked Laplace, and I'll put that up here. All right, so now I have 3 normal distributions here, but if I could also use a Weibull, an exponential, and a log logistic, just another way of trying to fit data to a curve. If I go to my model window, I now have 6 inputs. And I need to, and so here are my three normals. I'm going to select these three non-normals, and I'm going to add the correlation to them. So when I run the distribution, I do capture the correlations. So I'm going to correlate, right-click, correlate, create new matrix. Order looks good. Right-click, copy coefficients. Grab the actual correlation matrix I want to use. Put in a location from Excel. And I'll just put it right here, right below it. Okay, okay, and okay. And so here are the correlations for those three distributions. And then I'm going to go down here and actually create another area of modeling portfolio returns using the best fit distributions, where I'll just take 60% of the best fit plus 10% of the best fit. Whoops, I need to move this one back down. Plus 30% of the best fit bond, even though it wasn't the best fit, it was the second best fit. So it's 60 of 11, 10 of 3, 30 of the 5078. So I have an 8.8% mean. A little bit different because the means were a little bit different looking at this variable. I'm going to make that an output. Add output. And I want to copy these formulas down to calculate the 5% lowest and the probability of losing 30%. And then when I run at risk, it'll calculate those statistics for me. And I can compare those to the normal curve. So it looks like the 5% worst case is losing 12%, which is a little bit worse than assuming normal distributions. And you can see the distribution does seem to be skewed to the left tail. And that's based on our choice of best fit. And then the probability of losing 30%, you'll probably have a little different value because of the string. It only has a few outcomes here, so depending on your random variables that got selected down here. But I'm showing about a 0.2%, so maybe 2, 3, almost 3 times the risk if I assume normality. So this is how you can use at risk and not restrict yourself to normal distributions to estimate the risk of, say, a position. Now, the only reason I might still default to normal distributions is if I really want to do a good job of this, I would need to forecast the parameters for all these distributions. So, for example, let's look at if I had to forecast a normal distribution for equities. Notice for normal distributions, all I need to know are mean and standard deviation. So I could say replace this historical mean with, say, a CAPM return or a FAMA French return. And if I wanted to replace the standard deviation, I could replace that with, say, an implied volatility of an S&P 500 option, or an EWMA, or a GARCH value. However, if I wanted to do a better job of forecasting the future distribution for, say, my best fit here, I would need to replace the alpha, the beta, and the shift. Now, you can learn more about these by looking through the help, but I'm not real comfortable forecasting these variables. I guess I could manipulate them to try to get the mean and the standard deviation back to where I want them, but I'm not real comfortable doing that. So bottom line is you could use best fits to look at, say, historical risk levels. However, I probably would still may default to a normal distribution if I wanted to get a better picture for, say, the expected return in the future, even though I think this may capture the risk a little bit better of the tails. So that's using at risk to get a best fit line or best fit distribution and using it to forecast the risk of a position. And again, what I would really like to do if I want to do a really good job of this, really forecast what my expected return and standard deviation of that portfolio is, I would probably replace the T-bill historical return with the current T-bill rate, replace the T-bond historical mean with the current T-bond rate, replace the historical equity return with maybe the current T-bond rate plus a market risk premium. And then for the volatilities, I might replace some or all of these with EWMA or GARCH or implied vols. So let's do one more thing, not related to a portfolio, but look at an individual stock. So I'm going to grab this data. So it's a Walmart DCF model. I'm going to put that in Excel. So here's a simple free cash flow to equity model. Remember, free cash flows to equity are the free cash flows available. Revenue minus expenses, add back depreciation, subtract things like working capital. And for equity, you would also say add any bond issuance, since that would be available for stockholders, but subtract things like CapEx. So if I went to Yahoo Finance, I found that Walmart had $12.6 billion in free cash flows to equity last year, and they had 3 billion shares outstanding. In other words, they're generating about $3.93 per share in free cash flows. Now what I want to do is I want to assume that this grows at some constant rate and take a constant growth perpetuity to see what I would pay for Walmart. I'm going to discount it at a CAPM rate. So for CAPM, I need a risk-free rate, a beta, and a market risk premium, and then I need a perpetual growth rate. Now, the long-term risk-free rate, I'm just going to use the 10-year Treasury. At the time of doing this, it was 1.9%. For beta, now beta was a little tougher. Beta, I found a regression beta on Yahoo Finance of 30.3. However, when I looked on, say, DeModern's website and saw, well, what's the typical general merchandise retail beta? It's about 0.9. So I'm not sure what to use. 0.3 seems a little low. 0.9 might be on the high side. So I'm going to use kind of roughly in the middle of that 0.65. For market risk premium, again, this is my expectations of the future, what the average return on the S&P 500 might be over, say, the bond rate, short-term bond rate, or the 10-year Treasury bond rate. I looked at historically, depending on what time frame you use, you can probably justify anywhere from, say, a 3.5% return, which has been maybe the last 20 or 30 years of stocks over bonds. Over the long term, it's been as high as, say, 6.3%. However, the one I'm going to use for this estimate is I go onto DeModern's website at NYU, looked at his data, and every year he updates it with something called the implied risk premium. That is a forward-looking equity risk premium, and what he does, every year he looks at the current value of the S&P 500, has the forecasted cash flows of the S&P 500 stocks, and then what DeModern will do is calculate a simple growth model, DCF, and tries to figure out what discount rate will equate the cash flows, present value of the cash flows, to the current value of the S&P 500 at the beginning of the year. And then once he gets that discount rate, you can then subtract off the 10-year Treasury, and that's the implied risk premium. I'm going to use his as 578. And then I'll assume Walmart grows at 1% forever. Now, for a perpetual growth rate model, you never want to use a perpetual growth rate that grows faster than the economy. One proxy for how fast the economy is expected to grow is, say, the 10-year Treasury rate. 10-year Treasury rate should reflect inflation plus the basic growth of the economy. So I think it has to be something less than 1.9. Otherwise, if it grew faster than that, it would be growing faster than the overall economy into infinity or perpetuity. So I'm going to just go with 1%. Walmart's going to grow a little slower than the economy for the rest of time. I can then calculate my CAPM rate, risk-free rate, bond, plus beta times market risk premium. And then I'll do my DCF model, present value of a constant growth perpetuity, $3 per share divided by K minus G, my discount rate cap M minus G. That says that Walmart should be selling for $84, currently selling for $85, therefore you say it's fairly priced. This would be called a deterministic, static, or point estimate. So again, deterministic, static, or point estimate. In other words, there's only one possible value for all your inputs and one possible value for your output. However, we could turn this into a stochastic model. So let me grab a stochastic model. So a stochastic model is one in which there's a financial model with at least one input and one output, in which one of the variables is, at least one of the variables is stochastic. So let's create a couple stochastic variables. So here's going to be my stochastic Walmart valuation model. I'm going to take these three variables, I'm just going to turn them into stochastic variables. So for example, I found that I think the regression beta could be between 0.3 and 0.9, and I'm no more confident that it's 0.3 or 0.9 or 0.65. So the idea, I think it's equally likely of being the lowest number, the highest number, or one in the middle. If you have a situation after researching a stock or researching a variable that you think it has a flat distribution like that, you can click on that. I'm going to define a distribution. I'm going to select uniform. Okay, no peak. And then where it says min, I said that I think it's going to be somewhere between no less than 0.3 and say no more than 0.9. And I'll leave my static estimate. That's just sitting what's in the cell of 0.65. So now at-risk is going to write a formula. Risk uniform, min, max, static. Static is just what sits in the cell. And then market risk premium. Again, I think I really like 578. I think that's the most likely value. But it could be as low as 3.5, and it could be a little bit higher, 630. So I'm going to do a triangular distribution. Again, it's going to be bounded. Didn't mean to do that. Let me add a distribution. It's actually running the simulation from the last worksheet. So I'm going to add my variable for market risk premium, define distribution. I'm going to pick a triangular distribution, single peak, and it's bounded with a min and max. Except where it says min, I don't think the market risk premium could be any lower than 3.5% above treasuries. I'll go with my most likely. That's going to be my peak. That determines the top of that tent there. And then for max, I'm going to go with no higher than 0.063, which is the long-term average. Static value is what sits in the cell. And I'll hit OK. Notice it's creating this asymmetric distribution. And that's what it's going to use to sample. In other words, when I generate random numbers, it's going to generate numbers under that curve. And the last one, I'll pick kind of an interesting one, define distribution. I'm going to pick trigen. A trigen allows you to input a central value, a peak, and then put in a tail, not a min or a max, but a tail. So let me show you what that means. So let's put in I'll call it bottom. Let's just put it in minus 0.02. That's not the min, but we'll talk about it. Most likely 1%. And let's say the top, let's go ahead and put in 0.018. So I don't think that 2% is the minimum, negative 2% is the minimum. But if I actually here's the graph of this distribution. If I put in 10 here and 10 here, here's what I just input. I think the peak most likely is 1%. I think that the lowest 10% value is negative 2%. So again, based on all my analysis, I say, you know what? I don't think the min is 2%, but I think 90% of the time it's probably going to be less, greater than negative 2%. There's 10% of the time might be less. And then, I think 90% of the time it's going to be less than 1.8, but there's a 10% of the time it could be high. So instead of grabbing a min or a max, although I'd probably get the same thing if I said the min was negative 3.9 and the max was 2.9 and use a triangular. But by using this tri-gen, you get to put, say, a tail, either a 10% or a 1%. So I'm going to just input that one. So now, if I make this an output, again, now my formula is tied to this data, which are now stochastic variables. If I assume these stochastic variables are uncorrelated, I'm not going to add a correlation matrix. I'm going to make that an output and hit OK. I'm now going to run my simulation. So it's going to generate 10,000 sets of these three variables. Notice I'm getting an asymmetric payoff because I've picked some asymmetric distributions, those kind of funky triangles that are skewed. And here's my payoff. First of all, I'm going to type up here, the current stock price is 85. So based on my model, my understanding of Walmart, it looks like 55% of the time I'm going to lose money. 45% I'm going to make money, but when I make money with the distributions I put in, I can make a lot of money and I could lose a little. Now the mean of this distribution is 92. So actually, it looks like not a bad buy. If I can buy it for 85, the mean of the distribution is 92, and the reason why it's greater than my static value is because my understanding of the stock allowed me to put parameters in that shows this stock has a lot more upside than downside. So this may actually be, maybe a moderate buy instead of a hold because of the stock price. My estimate from the static estimate is strictly 85. So this is the difference between doing a static point or deterministic forecast where there's only one value for every input and one output to one in which we specify multiple distributions of inputs, which then creates distributions of outputs that allow me to make a more careful, informed decision. So in general, when I talk about static or stochastic decision making, static means you make your decision based on the most likely payoff, a single point estimate. Stochastic means you make your decision based on what could happen. What is the distribution of outcomes, not just what is the number I've forecasted. So for example, if you're simply using a static estimate for valuing a stock for Walmart, you would put in the most likely parameters, most likely values for every parameter, get one stock price. If that valuation is greater than the current stock price, you'd say buy. However, you've lost all that information that you've learned when researching the stock. By putting in distributions for beta and market risk premium and so on, you create a distribution of possible stock prices. Based on that, you can look at the mean of returns or even just look at the distributions and determine whether you'd like to buy the stock. So another example of using static versus stochastic decision making is if you simply use static decision making and look at historical returns on stocks, they're higher than every other asset class, say bonds, cash, commodities. So if you're only looking at what's the most likely outcome, so I expect, say, stocks to have the expected return of, say, 8 or 9 or 10% a year. That's higher than every other asset class. I would simply buy stocks and hold them all of my life because that's the most likely outcome. But by modeling stock returns and looking at the standard deviation, I'm not looking at, oh, the mean is 9%. I'm going to look at, well, the mean is 9, but the standard deviation is wide versus maybe a bond whose mean is less, but dispersion is less. And that would also tend to say, well, maybe as you get older, you care more about risk than return, or at least downturns in the market is going to hurt you a lot more when you're older. You have less time to recover. So it might change your way of thinking. Also, if you only care about mean, you don't care about diversification. By adding stocks, bonds, and bills together and the relatively low correlations, I can narrow these gaps. I'm going to reduce my return a little bit by adding bonds and bills to my portfolio. However, I'm going to greatly reduce the risk. Now, in life, there's lots of reasons. In life, we actually do use stochastic decision making. I'm not sure why we don't do it more in financial markets. So, for example, your choice to buy auto insurance is pretty clear. Most people, you buy it. However, if you just did a static estimate of car insurance, any given year, either auto insurance, home insurance, life insurance, health insurance, in any given year, if you're relatively healthy and drive relatively safely, you're not going to die. You're not going to get in an accident. Your house is not going to burn down. You're not going to need a major surgery. It's going to cost a lot of money. So using a static estimate, I would never buy insurance. However, you know that these things do happen, right? It's not likely I can get a car accident, but there's some probability of having a car accident. Therefore, and I know if I get in a car accident, I could lose the value of the car. Therefore, I'll buy self-insurance. Or why most of you hopefully are not drinking and driving. If you did a static estimate, you'd say, any given night, I'll not expect to get caught if I were driving drunk. That's a static estimate. Therefore, drink and drive. However, if you look at the possible outcomes, well, any given night, there's only a 1% chance of saying get caught. Yeah, but that 1% chance is still a chance, even though it's not likely. And if it does happen, it could kind of ruin your future, or at least a short-term future, job prospects, things like that, ability to drive and get around. So you might determine that you're not going to drink. So things we take for granted using stochastic analysis, what could happen that make decision makings, we don't seem to use in financial markets. So in this topic, we selected distributions other than the normal distribution and modeled portfolio returns and free cash flows. We also used distribution fitting, and we inserted distributions a little bit different way using the Excel's distribution function instead of just typing risk normal.